of Canada has announced this morning it is holding steady its key interest rate at 5%. It has many people who are looking to renew their mortgages wondering if they should lock in long term or maybe choose a shorter term. Joining us now with some things to consider is Peter Sashecki with Everything Financial. Good morning, Peter. Good to see you.
Good morning, Carrie. Nice to see you.
Okay, so the Bank of Canada making the announcement this morning, holding its key interest rate at 5%, not unexpected. What is your reaction to that this morning?
World's worst kept secret. It's irresponsible of the Bank of Canada, but as the governor said a few months ago, that they take their direction from the government of Canada, and the government of Canada seems, determined to keep these rates artificially high. All the top economists say the rates should have been lowered at least 1% by now, but we're just going to have to wait and go through this horrible high interest rate climate for probably another couple months before the decreases in interest finally start to happen.
Yeah, there are some that are saying that we're looking at least June before we do see any kind of drop in interest rates.
Yeah.
Okay. But, if someone is trying to get their mortgage renewed right now, they're trying to figure out which way they should go. And so they have the option of maybe locking into something that's longer term or maybe a shorter term. So maybe break down what the difference there would be and what would be a better option.
Yeah, I would, if I was renewing today, I would go with the shorter term, the 1-year mortgage. Now, it sounds like it's a really high rate because you're getting that high 6% versus, say, a high mid 5% rate. But it's really that cost difference of that, just over $7,000 is only the cost for the first year. The big change is what if you change or you're able to change that mortgage after a year, because we know, and again, worst kept secret, that the rates are going to have to come down quite a bit to get closer to where inflation is now at. So don't get stuck with the big penalty. The mortgage may cost you $7,000 the first year, but you're going to save over $20,000 in fees if you went to change, from a 5-year and then, changing to a 1-year or a variable or something else in a year from now. So the longer you have to go till that renewal, the better. But whatever you do, Carrie, when you get the renewal letter, don't just sign it and send it back, because it will default to the 5-year. And that is not in your best interest right now.
Really important that people look over that information. And yeah, it's really good information you mentioned there. I think a lot of people do think they'll just go for the shorter, the smaller interest rate, and that would be the longer term, but that may not be in your best interest. When it comes to these long-term and short-term rules, though, do they carry over to other areas such as lines of credit?
They do. So a line of credit will decrease as the interest rates come down. So they drop a quarter point, your interest rate is going to come down a quarter point. Same with a variable mortgage. And here's one of the big things, Carrie, with the 5-year variables. They have a discount below prime. Because of rates right now, that discount is not very large. But as those come back in, rates go down, you will probably find the variable mortgages with a larger discount. And remember this, Carrie, too. The bank's not going to give you the best rate. They're gonna give you like a posted rate. They have wiggle room. So a lot of times you can go to a mortgage company with a broker and get a better rate at your own bank than they will give you.
Oh, interesting. So it might be worth your while to get on with a mortgage broker, and they can hunt around for that deal.
Yeah, shop around for sure.
Peter Sashecki with Everything Financial. Thanks for your insight this morning, Peter. Have a great day.
Thanks, Carrie. Great to see you, and we'll see you next week.
Yeah, sounds good. Thanks, Peter.